We're here to talk about the Silicon Valley real estate marketplace ending the week of March 20th, presented Saturday morning, March 21st. The reason that I'm dated this March 22nd is that is what I'm comparing the past 10 years to. I use a calendar year that starts on March 1st and jumps forward 7 days at a time until you get around to February 21st, where it jumps forward 8 or 9 days, depending on whether it's a regular or leap year. These are the key chapters we're going over. I'm Richard Calhoun. My contact information is down below. I'm a real estate broker with Creekside Realty. Let's get into the first data slide. Here, what we're looking at is three key components. The first one is turnover time. That's the theoretical time on how long it takes the market to sell out one time. This is for Silicon Valley, 3 counties, Santa Clara, San Mateo, and Alameda County. You can see it's been climbing the last several weeks. Moving on to the next slide is offers down here in the orange. You can see the number of offers accepted is turning downwards. And then the third one is the active inventory. Active inventory is climbing. We're approaching our record high for the last several years, the last 6 years. Your initial reaction might be, my goodness, the market really has changed. Silicon Valley, because I've looked ahead, and Silicon Valley has changed more than the other 4 regions that I also follow. So you may want to jump back in at the very end and look at how the other regions are comparing, because whatever's impacting the real estate market appears to be impacting Silicon Valley, not the entire Bay Area. Moving on, here's the turnover rate. It's a slightly different presentation. This current week is in the middle line right down through here, and that's why the purple line ends. That's the current data. The colored lines, the blue is the line that favors the buyer the most, the gray is the median based on the past 10 years, and the red is the one that favors the sellers the most based on the past 10 years. I believe real estate is very cyclical. It's got huge seasonal cycles. It's also got a weekly cycle, and anyone that's in the marketplace obviously knows the open house weekend activity that then reports sales during the week. So I do everything on a week. My weeks start on March the 1st. Because on February 29th, you have a discontinuity and you have 1 extra day. That way, I reset the calendar year every year on March 1st. I go forward 7 days at a time until you get down to February 21st, and then I jump forward either 8 or 9 days. That's why my slide says March 22nd instead of March 21st. I'm presenting this on the 21st, but the data, the 10-year data is actually as of tomorrow, the 22nd. I compensate for that by going back 1 extra day the first week. Once I have the 22nd data in there next week, when I update the data, I am using the 22nd. So it's only the first week when you're trying to get back to those whole week that matters. Anyway, you can see that the turnover time is up here right at the cool. It's at 42 days. The most you'd expect is 39 days. Still to turn over your entire inventory in just over a month that, call it 6 weeks, is still a fairly aggressive marketplace, but Silicon Valley is normally aggressive. Now, notice marketing time. You would think that'd be related to turnover time, and it's not. And the major 2 reasons are turnover time includes all sellers, including the sellers that are not successful. Or marketing time, you have to accept an offer in order for me to know how long it's going to take for you to accept that offer. The discrepancy between this being very cool and this being absolutely normal is there's a group of sellers that are coming on the marketplace that are selling in the normal period of time. And then there's a group of sellers that are coming on the market that are simply not selling and are going off the marketplace and without selling. Well, your actual time for 3 out of 4 successful sellers to sell is 17 days. So that means the successful sellers are doing it in 3 weeks. That's still a fairly fast-paced marketplace. That is roughly 10% longer than it normally is. So your typical is at 16 days. Price reductions. You can see price reductions are a little bit on the blue side of the gray line. So we're taking a little bit more price reductions. What is that? We're currently taking a 0.5% price reduction. That may sound like a very small number, but that's because a large number of sellers do no price adjustments at all. Normally you're at 1/4, so you're almost double. You're at 175% of the price reductions you normally are. But when you're talking about such small numbers, I'm not sure the magnitude of the delta really matters. You're roughly double the price reductions you normally are taking. They're still small in magnitude. Overbidding, what are the buyers doing? The buyers are still overbidding more than they normally overbid. What are we talking about in numbers? They're overbidding currently at 8.2%, and 6.9% is where they normally are. So they're overbidding 1.3% of the sale price more over than they normally do. How do I reconcile that apparent discrepancy? Remember, to get overbid, I need the closed escrow. These are a delayed factor. If you go back 3 to 6 weeks, we're pre the Iran hostilities, and that may be what triggered it. I actually suspect, on some data that I'll throw out a little bit later, I think it's related to that, but I think it may be more the pocketbooks are getting hit by the worker-bee home buyer, and the gasoline prices going up basically $1 a gallon may be shocking that part of the marketplace. That may be what's going on. Offers. You can see offers are getting real close to the blue line again. We're only at 84%. We were all the way up to 93%, I think. So we're down 10%. You're only at 2,000 transactions. But you also need to keep this in perspective that we've been at this 80% level ever since the 2022 price correction settled out in about 2023. Actually, 2023 was missing about 30% of the market. 2024 was about 20%, 2025 was about 20%, and now 2026 looks like it's going to be about 20%. So we had a brief period of time up here where we recovered, but I'm not sure that that was actually a market recovery, or because it wasn't long enough in duration, or was it just an anomaly? Inventory is clearly growing. We're having some of the highest levels of inventory. You can see we're approaching the blue line. We have not been at that level. We have now what I would call a surplus of inventory. You have 2,300 homes for sale in the 3 counties when you normally only have 1,800 homes. Number of transactions closed. This is more of a point of interest. You can see we're way down here. We're almost at the blue line, but on a percentage basis, it's 88%. The reason that's a non-issue is it's closed transactions, but it's an issue in the fact that that's what the industry drives on, closed transactions. Here now is a summary chart. You can see the different metrics going across the top. The first ones are the current market conditions. So even though these are the current market conditions, which are pretty aggressive, the only one that's sort of balanced is price reductions. You're still moving quickly. Even overbidding, which is the lagging indicator, which is why it's a deep orange at the top, or is a red hot. But now come over here and look at the green, which is comparing to the 10-year median. Everything in here is basically normal. Your turnover time is actually cooler than normal. You can see there's a lot of blue in this column, but every other column most of it's green, first off, which is a balanced marketplace. The blue and the red are roughly balanced in each column. So that's basically telling me that the market for Silicon Valley is where it normally is based on the past 10 years. Now, you can have a big debate on whether the past 10 years is a good benchmark or not, but the market is becoming smaller and smaller every year, noticeably smaller. And I don't feel that I can go back and compare it to the past 25 years. So that's why I've picked the past 10 years. So that's sort of normalizing it. Yes, in any 10-year period of time, you don't have 10 normal years, but it sort of balances out. Then you have offers. So you can see offers are on the blue side, especially in Alameda County. And this is sort of the first indication that this might be the person that's paying gasoline prices that impact their pocketbook more. The other place you're seeing it is, notice in Santa Clara County, the more affordable areas are at a lower percentage of normal than the expensive areas. The expensive areas are moving along at basically 100%. Those are the indications that I'm picking up that suggest that it may be more related to the gasoline prices and people feeling it in their pocketbook and not willing to take on more debt at a time when they're now feel even more strapped and combined with inflation. Active inventory, you can see that all the areas are over 100%. The only area that I'm seeing less than 100% is the expensive areas in San Mateo County, all the expensive areas in Santa Clara County. So right along the Santa Clara, San Mateo County corridor, which is the expensive areas, they have less inventory than they normally do. Everybody else is above normal, with Alameda County at 13%. San Mateo overall is at 38% above, and Santa Clara County is 39% over, yielding 29% more inventory than normal for all of Silicon Valley. Then you have appreciation, and that's since the last 9 months of 2015. You can see that some areas have hotter appreciation and some areas have cooler. I define that, you have a range of appreciation, and the ones that have the most, which is Santa Clara County at 118%. But now pay attention, at 118%, I shouldn't be using this to set the benchmark, because notice that every micro market area has a lower appreciation rate. How can I justify that? Easy. It's not data error. It's these areas down here, the Los Altos, the expensive areas that are selling a greater percentage of the marketplace. That brings up the median for the whole marketplace, the whole county, but doesn't impact the median, the appreciation in each given micro market area. And the final column is price. And instead of following just the median number, which is the middle number, and that is what I assign the color by, I sandwich it with the lowest 10 percentile and the highest 90 percentile in each area. So I'm right now in central San Jose, like downtown. You go from 850,000, 1,650,000. So that's your price range, with the middle being 1,125,000. Here's some clear definitions you can go back and read. Here's the first micro market area. So now what you're looking at is the turnover rate. So the turnover rate is still quick. You can see it's a little bit slower up here in Alameda County and also down in South County, but overall it's a fast-paced marketplace. Now you compare the same information to the 10-year median. You can see that you're blue in color along the affordable areas, you're normal along the more expensive areas. Again, another indication that it might be gasoline price driven. Marketing time. Fast all overall when you're looking at raw counts, and fast is from 1 to 3 weeks. So all these areas that are in red are selling in less than 3 weeks. Compared to normal, it's absolutely normal. Look how much green there is. There's very little blue over here on the San Mateo County coast, and that's a small micro market area. But most of these are shades of green and yellow green and blue green, which are all the normal ranges. There's essentially no blue, and there are a few areas of red. So again, your marketing time is fast and is, I would call it, normal. Here's your price reductions. Price reductions are a little bit normal, which would be a higher number up along the more affordable areas. They're red in color, which is less price reductions here now as compared to normal. The Los Altos, Palo Altos actually having more price reductions than they normally do, but most of the valley is balanced because you got some pink in there, you got some blue greens, you got some yellow greens, you got some greens. Any shade of green is normal. Any shade of blue is starting to favor the buyer. Any shade of red is starting to favor the seller. Here's the frequency of those price reductions. So very infrequent. You can see red overall. To be red, you have to have less than 17% of the sellers, less than 1 in 6 sellers doing a price reduction. Compared to normal, look at where the blue is. Again, the more affordable areas, the areas that are more likely to be impacted by the increase in gasoline prices, are seeing an increase in frequency compared to normal. The expensive areas over here on the west side of Santa Clara County, they're coming along and saying we're doing less frequent price reductions. Overbidding. This is a lagging indicator. We have to wait for escrows to close. But again, very red in color, which says a lot of overbidding. I mean, when you're getting 8% overbidding, but again, this is a lagging indicator. Compared to normal, you're only at 1% above normal for all of Santa Clara, all of Silicon Valley. Santa Clara County is 0.3% below. San Mateo County is almost 2 percentage points above. And Alameda County, surprisingly, is almost 3% above normal. Frequency of overbidding. How common is overbidding? Red, so very frequent overbidding, 70% for all of Silicon Valley. Compared to normal, it's 99% of normal. So again, the global takeaway, in my opinion, is the market is still a very aggressive marketplace, but it's a normal marketplace for Silicon Valley. Offers accepted, you have fewer offers accepted. We've been missing that. But again, notice the bluer areas are the more affordable areas, the areas that are more likely to be impacted by the price of gasoline and maybe even just the price of groceries. Now you're looking at the active inventory. You're starting to see blue in a good part of Santa Clara County. The rest of the valley seems to be balanced. Let's look at it. 28% more inventory than normal. 39% in Santa Clara County, 38%, which is sort of surprising in San Mateo County. I guess it's Pacifica Daly City is an actually fairly large area up there, and that's almost double the inventory that they normally have. And then Alameda County, I don't have micro market data, but it's 13%. So it's got the least extra inventory. Here's your appreciation areas. So the same areas that are doing poorly now, sort of the affordable areas, have had the best appreciation rate overall. But again, you can see a lot of the areas are normal appreciation. And normal, you know, you'd expect them to be normal because you're defining it, the range. You find the biggest appreciation and the least amount of appreciation. And thinking about it, and I think I have to go back and change my metric, I'm probably including this 117%, and I really shouldn't be. I should be only looking at micro market data for setting my range. And then here's your prices. The blue color is not favoring the buyer, but it does in the fact that it's the most affordable. And red favors the sellers because they get the most money. It's the most expensive. So it's not favoring one side or the other. It's the more expensive is red, the blue is the cheapest. And here's the summary chart that we went over in the bottom. And I don't think I mentioned it at the start, but I've added in the range down here at the bottom and sort of color coded it. So I hope that may help. Here's some definitions moving onwards. Now what we're looking at is the 3 counties in a blender. We're looking at the typical, which is the gray line, the line that favors the seller the most down here, and the line that favors the buyer the most. And this is turnover time. So turnover time has been climbing for the last several weeks and is now above longer than you'd expect it to be. The time that it takes to sell your inventory one time, it's theoretical, is higher or slower than normal. Here it is on a percentage basis. You can see just about 6 weeks ago, we were down here where we were, maybe 8% slower than normal. And now we're up here at something approaching 38% more than normal. It's probably closer to 36%. Here's marketing time. This is the sellers that are successful. So now we're only counting the successful sellers. We bottomed out here at 15 days. We're now back up to 17. So we've increased 17 days. It may not sound like a lot, but that is actually a significant change, especially because notice the trend line is down. So you've leveled off and you've gone up now. The last 2 weeks, we've gone up. Well, I think that's 2 weeks of data. We're going up at a time when the market's normally plateauing or still decreasing. So that is a change in direction for normal. Here's on a percentage basis. You can see we're down here. We hit the bottom of about 38%, which would have been very fast. And now we're at 110%. So a fairly marked change, but you're still close to normal. Here's the sellers that are taking the largest price reductions. How big of a price reduction are they taking? Just over 9%. 9% would be right here. We're just below that gray line. So you're a little bit, maybe 9.25%. This is the top 2.5% of the sellers that are taking the largest. I actually like this data because so many sellers take no price adjustments. Here's the average to show the data is roughly the same, but the average here, you're taking 0.5% of a price reduction, very small because so many sellers take 0. Here's on a percentage basis. You can see just a few weeks ago, we were taking absolutely normal price reductions. Now you're taking significantly more price reductions. And, on a percentage basis, it's not significantly more. But when you look at the whole range for the area, it's only a range of 24 grids, and you're already down 3/4 of one grid. That's why I'm saying it's somewhat significant of a change. Here's the frequency. So the magnitude of only 10% of the sellers in Silicon Valley doing a price reduction is not very significant. But again, it's the change that you've gone up at a time when the market is normally still going down. Normally, we'd be approaching some number around 7.5%, and yet we're at 10%. So you're a third more of the sellers that are doing a price reduction. It's still a small number, but it's a third more than normal. Here's the frequency on a percentage basis. You can see the third I was talking about right up here. So it looks like a third was a little aggressive because that would be 30% here. It's something closer to 28%. But just a few weeks ago, we were down here at about 78, about 82% or something of that order. Here's overbidding. Now, this is a lagging indicator, and it's behaving absolutely normal. You're right. And this is the median. So one time I showed the median for overbidding. You're right on the gray line, right where you'd expect it to be. So half the buyers are overbidding by 5% or more. Half the buyers are overbidding by 5% or less. Here's the overbidding on raw count. So what I do is normal overbidding is 0. And I forgot what the numbers were. They were about 6.9 maybe and 8.3. So it's about 1.4% more overbidding, and 1.5 would be this horizontal gray line in the pink, and you're below that. So that's about the right order of magnitude. So overbidding is 1.4% roughly more higher overbid than they typically do. So if overbidding was typically 5%, now it's at 6.4%. Here's the frequency of overbidding. Frequency of overbidding is dead normal. Again, it's a lagging indicator, just above 70%. 70% is going to be the horizontal gray line. You're right on the gray line. You're just over 70% at about 70.75% overbidding. So that's 7 out of 10 sellers bidding more than their ask price. Here's the frequency compared to normal, and you can see you're very close to the normal level of overbidding. Offers accepted. You can see that we plateaued. And again, that's significant in the fact that you're normally climbing very rapidly. You're normally on this gray line. So to come over and plateau is significant. When there was a break right here where you're going up but fairly steeply, but not as steep as normal, it's hard to call it. But now that you sort of plateaued, that's a change for Silicon Valley. And again, I want to caution people that may not listen to the whole end or jump back in at the end. I follow the 5 regions at the very end of this presentation, and the other 4 regions are not following the same trend as Silicon Valley. That's why I'm a little hesitant to blame this on the Iran war hostilities, because if it was something international, it would be impacting the whole real estate market. Whatever's going on in the marketplace appears to be at this point in time impacting only Silicon Valley and not the surrounding 4 regions. Those are San Francisco and Marin, Sacramento and San Joaquin and Central Valley, the Central Coast, Santa Cruz and Monterey. Oh, North Bay is the 4th, which would be Solano, Napa, Sonoma, and Contra Costa County, and Silicon Valley being the 5th. Here's my pricing model. You can see we had about 12.1% appreciation, then we've been basically flat. We're still on the steep part of the climb. We're still not above the 2022 price peak back here. We're climbing pretty quickly, but this may roll over fairly soon. Here's some definitions for coming up on the next slide. What we're doing here is we're going to go through essentially the same metrics, but now we're comparing the 3 counties. So I've already sort of did a spoiler alert by saying whatever's happening is happening in Silicon Valley. Let's see if it's happening more in one county or another county. This is the turnover time. Alameda County is in the gray. It's fairly flat, but increasing. San Mateo County is in the orange. It's gone up the most aggressive. And Santa Clara County is in the blue, and it's gone up, but not as much as San Mateo. Here's the time to sell. Time to sell is flat in Santa Clara County. It's going down in San Mateo County, and it's flat in Alameda County. So the time to sell, and this is a typical time, this is a successful seller. The successful sellers are still selling in the same amount of time. This is the price reductions. Flat in Alameda County, flat in Santa Clara County, increasing in San Mateo County. Frequency of price reductions, decreasing in San Mateo County, increasing in Santa Clara and Alameda County. So clearly mixed signals. You know, you would think that the frequency and the magnitude would be going up the same. The magnitude is the highest in San Mateo County, but the frequency is going the other direction. The data is accurate. What the hard part is that is challenging is trying to understand what is the simplest explanation for the nuances we're seeing in the data. Now we're looking at overbidding. Alameda County is shooting up the most, and that's been the case for some time. But again, this is lagging data. So if you're blaming anything on gas prices or the war hostilities, it's too early to see the impact yet because those were transactions that were negotiated beforehand. Here's the frequency of overbidding, still climbing in all 3 counties, and again, a lagging indicator. Offers accepted. Notice that they're basically clipped in all 3 counties. Number of offers that accepted would normally be going up every week, basically, except holiday weeks, through the week before Memorial Day, basically the end of May. So the fact that you're clipped here is, you know, unusual. But now if you come back, you know, with that perception, yes, the end of May right here is sort of the peak. But look, right at first quarter, you have this plateau. And it, you know, it happens at different times. Here's halfway through first quarter, right at first quarter, or halfway through second quarter for these first couple of things. Sorry about that. towards the end, well, halfway through third quarter was the peak activity. So you got to pay a little bit more attention to then your global offers accepted going up every week. The fact that we're rolling over is not unprecedented. In fact, it happened in several years, but one of the years it happened in is 2022. And I don't think any of us want to repeat 2022. Active inventory climbing in all three regions, and it normally is climbing at this time of the year, so that's nothing unusual. Appreciation, Santa Clara County has the highest appreciation by far, but remember I pointed out that it's got the market mix shift happening. Here's your pricing. San Mateo County is back on top, and then Santa Clara and Alameda is the most affordable. This is on log paper for appreciation. Here it is on regular paper, so you can see that Santa Clara is at 2.1. San Mateo's up to 2.150. So there's about a 75,000 gap between the two because Santa Clara isn't quite to 2.1. Here is the payment using the high balance interest rate as published by the Federal Reserve Bank, which is 6.22%. It went up from 6% to 6.11% to 6.22% in 2 weeks. So we basically had 2.18% increases week after week. Here's the sales volume, nothing unusual other than we're now back up into 8th place out of the last 10 years, and that's not good. That's the 8th slowest and the 23rd slowest out of the last 25 years. We're not back at 24 and 9 like we were at the end of last year and earlier in 2025. Here's the raw number for Silicon Valley, Santa Clara County, San Mateo, and Alameda County. Again, I'm using the 22nd because that's what the date's normally for, even though the data obviously is only through the 20th. Here is some customization I do for buyers. Here is how you join on the presentation live. This is Silicon Valley real estate market. We then offline and then post on the amend to this, the Greater Bay Area, 13 counties and 5 regions. If you want the handout, today's handout is up. You can type in the longer blue URL or the shorter green root URL followed by the letter H for handout, the year 2026, month 03/21 for today's date. I don't use the 22nd because I don't think the layperson's going to keep track of it. Saturday's date is always the handout. And join the presentation live Saturday morning, the green root URL plus 2026 or the blue Zoom meeting link. And the archive is on YouTube or the green root URL. I'm Richard Calhoun, real estate broker, Creekside Realty, working with buyers or sellers in single agency transactions. Appreciate likes and subscriptions. Let's move on. Here's some definitions for the key distributions we're going over next. This is marketing time. So now what you're looking at is from 50 percentile up to 90 percentile. So you're looking at 40% of the marketplace. Down here, you gain no value. So I want to make it easier to see the trends and things of that nature. You're starting off on the dotted line down here, the bold dotted line. The purple line is where we are right now, the current week, but that's after going all the way through. So we start off on the dotted line and let's see which direction it goes. It's going to go up because there's nothing lower than that. You can see what's that telling you? You expect the purple data to start taking longer and longer marketing time. You can see that there's a slow march up as we go through the year. This is still May, which people think is a great time to sell, but it's actually still significantly slower than right now. Now you're starting to have a little bit of a plateau. Sort of the summer plateau started, I think, on July the 4th, and then just is sort of bouncing around all the way through the 13th of September. Then there's a huge improvement to the middle of October. There's October 11th. That's sort of the bottom of the improvement. Now you're slowing down for the end of the year. There's Thanksgiving. Now you're into December. There's the slowest time of the year, January 3rd, right after the first of the year. And then you start improving rapidly. Look how steep these are getting on this side. There's sort of the bottom. And when we go forward, see how flat that gets? So that means it's already deteriorating, even though you can't really see the change in the line. And now on the purple line, there was a movement up. So we're already past the fastest time to market. One of the things that people have suggested I do is tell buyers and sellers what to do. It all depends on what you want. Do you want the fastest marketing time? You've missed the boat for this year. Do you want the maximum price? That's usually happening right about now to the middle of April. It all depends on what your motivation was. Are you a move-up buyer or are you a trade-down buyer? Here's the largest price reductions when we're looking at the purple line is the current data. The dotted line is where we're starting off. Same concept. But here we're going from the highest 2.5 percentile sellers down to the 82.5 percentile. So 15% of the marketplace that's taken the largest price reductions shifted downwards by 2.5% to get rid of data entry errors. We're going to start off same concept. Right off the bat, you can see it's doing the same as the other slide where your marketing time, you're taking larger and larger price reductions. As you get into May, now you're at the end of May, now you're into June, end of June, July 4th. There's the plateau, July 19th. And it's a plateau and more reductions. Now you're improving. There's that improvement. Middle of October is sort of the peak of the improvement. Now it's deteriorating into Thanksgiving and then into the end of the year. There's December the 6th. Sometimes right there on December 20th was sort of the bottom. Sellers start getting aware that the market's going to improve the next year and start being reluctant to reduce the price because they know the market's likely to improve. That was the peak up here, and you've already passed the least amount of price reductions, and this is back to where we are today. And then overbidding, we're going to start off right at a competitive plateau, and that's in part because we're lagging behind by 5 weeks. Same concept. Here we're looking at pretty much the whole range. We're going from 5% overbid, the buyers that are overbidding the most 5%, to the ones that are overbidding the least and actually going down. You can see at 5%, you're only about a 6% price reduction. At 5% over here, you're at about a 40% price increase. So buyers are willing to overbid far more than they're willing to go in under the seller's ask price. It's always been that way since I've been in the business. Buyers are hesitant to make offers below the ask price, even when they're in a slow marketplace. They typically wait for the seller to reduce their price. I don't understand it. I encourage my clients to make offers. You don't get your hopes up, but you make your offers, and you never know. If it's a house you meet your needs, you think it's a property you want, you just disagree with the seller on the price, you test the marketplace. Here's the overbidding, same concept. Right off the bat, you're started on the dotted line. See how you're not really moving, so that's why I'm calling it a plateau. Still haven't really moved. Now the plateau sign goes away and you're going down, so you're cooling. But again, this is where the market is 5 weeks earlier. You're still going down. Now that's August and you're still going down. There's the middle of August. There's the end of August, and that's sort of the bottom. Now you're improving in the month of September. And there's going to probably be the peak at the end. Okay, we got a plateau in November. And then we start going down for the end of the year. And the bottom is going to be at the end of January right there, because again, the 5 week lag. You have to adjust that all the time. And one of the things I'm looking for is leading indicators. One of the things that always bothered me about the media is they talk about the sold price. Well, the sold price is history of what's already happened 5 and 6 weeks ago. With that, let's go through real quick, see how far in the greater Bay Area we can get into. These are the counties and the regions. Here, look at what's going on now. Turnover time, it's up in Silicon Valley, and it's also up in the cities. All the other regions are down or flat in the Central Coast. Time to sell, up in Silicon Valley, down in all other 4 regions. All other regions are going down still. Price reductions, flat in Silicon Valley, flat in pretty much everywhere except for the North Bay, and the North Bay is increasing price reductions. Here is the frequency of price reductions, significantly up in Silicon Valley, down in cities, down in all 3 of these regions. So again, Silicon Valley is more pessimistic right now than the other 4 regions. Here's the overbid. Overbidding is still, and this is a lagging indicator, is going up in all regions except for North Bay. Central Valley and Central Coast are flat. So Silicon Valley and cities are the only 2 regions that are going up. Here's the frequency of overbidding. They're going up in both Silicon Valley. They're going up in basically all the regions, maybe plateauing here in North Bay and plateaued in Central Coast. And again, lagging indicator. Offers going up in all regions, but look at Silicon Valley. It's flat. It's up in North Bay. It's rolling over maybe in the Central Valley, and the Central Coast and cities is still going up. So again, Silicon Valley is acting differently. all 5 regions are having increased inventory. Here's the appreciation. Silicon Valley has the highest appreciation. And again, I said that's